who that walk-on song was for. I don't think it was me, but I guess it was for them. Welcome, everybody. I've been looking forward to this fireside chat. I'm here with Renaud Laplanche. He was the original co-founder of Lending Club, which was one of the very first marketplace lenders in the U.S. ever. Lending Club and Marketplace and Prosper started around the same time. So I don't know if you could call yourself the father of marketplace lending or an uncle of marketplace lending.
Co-founder.
Co-father, yes, stepfather. And so he was Lending Club CEO for 10 years, and then after leaving Lending Club, he shortly afterward founded a new company called Upgrade, which is an online lender. And before that, he also founded a software company called Triple Hop Technologies. Tell us a little bit about Upgrade, the kinds of loans you make, and your overall business model.
Yeah, so Upgrade is a sort of online consumer lender. We really focus on trying to bring affordable and responsible credit to our customers. And so one way to make credit affordable is to operate at a low cost and also source low cost capital. So a lot of the capital comes from banks and credit unions that have sort of lower costs of capital and lower return hurdle than asset managers and hedge funds. And the type of loans we make are really what we define as responsible, which tends to be sort of personal loans that really help our customers pay off a credit card balance at a lower rate with a fixed rate and a fully amortizing, so with a straight line amortization balance. That's really in contrast to sort of credit cards that often have a monthly minimum payment, and if the only payment you make is going to take 25 years to pay off the balance, and you'll end up paying back 3 times what you spent. So really help our customers be responsible with their lending. We also make lines of credit. We're launching a credit card, but all these products have the same focus of being consumer friendly and helping them better understand their credit and do the right thing with their credit. So along these lines, we also have a free product we give to all our customers and everybody who wants to take advantage and goes to the Upgrade website called Credit Health. That's a series of credit monitoring, credit alert, and credit education product and features that really help our customers better understand their credit, better manage it, and get to a better place.
And do you have people actively using Credit Health, and are they seeing it make a difference in their financial health?
Yeah, so we're seeing very strong engagement. So about 25% of our customers who are signed up for Credit Health use it at least once a month. And out of these customers, we see them having a 40% better credit performance than the average of our customers. So we still don't know for sure if it's a selection bias or if we are really sort of making a difference in shaping their behavior. So we're testing that a little bit more and trying to understand, okay, we hope to believe, we hope that we're making a difference, but there's certainly a bias as well with the most responsible of our customers being the most likely to use Credit Health. But in any case, we're driving more engagement and we are developing more features to continue to help our customers sort of make the right credit decisions that are going to improve their credit standing in general and their credit score in particular. And credit score has become so important in everybody's life now. It's not just something you use to get credit. It's also something that will have an impact on how much premium you pay on your car insurance. So everybody, whether it's insurers, lenders, a lot of service providers are using the credit score as a proxy for someone's responsible behavior. So helping our customers really sort of improve on their credit is, we feel, really part of the mission.
That's interesting, because obviously credit scores are super important today, and yet online lenders like yourselves are de-emphasizing the credit score. You're using more cash flow and other means of determining someone's creditworthiness. Tell us a little bit about your underwriting, how you go about it, and where do you see the future of the credit score?
Right. So credit scores, and particularly the FICO score, still has quite a bit of predictive power in the middle of the credit spectrum. right? In the top end, people don't use as much credit, and it's so you don't have as many data points. At the bottom, it's a thin file, really don't have enough data on their credit score. Subprime, it goes in and out. But in the sort of 660 to 720 range, the FICO score tends to be fairly predictive. As far as we're concerned, it's only one of 200 data points that we're using. So we're not relying on it, but we just incorporate it in our underwriting. We do use a lot of other type of data, including behavioral data, and also really cash flow data that really hasn't been used much in the space so far. And really the free cash flow data helps us differentiate between someone who will be earning $60,000 in New York and someone who will be earning $60,000 in a small town in the Midwest, with obviously a very different cost of living and spending pattern.
And it's a signal of responsibility, I guess, if you can keep a certain amount in your account without spending it. There's probably a million ways to look at that, but
that's right, and we feel it's something that is helping our credit performance now to an extent, but will be particularly helpful in an economic downturn when sort of cash becomes more important. Having a cash cushion becomes critical as more people lose their job, and those who have some savings will be able to keep making a few payments on their loans before being delinquent. So then we'll be in that situation where they have 3 to 6 months where they can find another employment and really avoid becoming delinquent.
And just to close the loop on what you were talking about earlier, would you say the key differentiator between Upgrade and others offering personal loans, like your ex-company and a number of others, is the credit health component, or are there other things you're doing that you feel are significantly different?
So yeah, I think there are a number of things where we, I mean, as you can imagine, in the last 12 years, we learned a lot, right? So there are a number of things that are different. So certainly credit health, I think, is part of a broader observation we had made earlier that we need to find ways to be more helpful to our customers and move away from a purely sort of transactional approach to more of what banks have done for many decades of almost relationship banking, or at least having that ongoing conversation and ongoing relationship with our customers and be useful to them outside of specific transactions in a way that would create more brand loyalty and more brand awareness, and just makes it more likely for that customer to come to us for their next credit needs. And then it's a matter also of offering the right sort of transactional product, and personal loans are wonderful products, but we've been developing sort of new and interesting products like line of credit and now a card. I think the Upgrade card in particular is very unique in the sense that it sort of combines the two products that have been available in consumer lending for the last few decades, like credit cards and personal loans. So an Upgrade card is a piece of plastic. It's also a tokenized card, so you can swipe it at the point of sale. You can store it in Apple Pay or any other digital wallet. So it has all the sort of point of sale convenience of a credit card. It comes with a line of credit, so it has that utility of the credit card, but then the balance at the billing cycle turns into an installment plan that our customers pay off over 12, 24, 36 months. So it with a fixed rate and a fixed sort of straight line amortization schedule. So it just combines this utility and convenience of a credit card with the low cost and more responsible borrowing of a personal loan.
So you're kind of borrowing from that POS loan market that Affirm basically started, and it's become so popular. And how many users does Upgrade have, or how many customers, and how many loans have you made?
Right. So we've made about $2 billion in loans over the last couple of years. So we're ramping up fairly quickly. We did $250 million in the first year, and then we ramped up last year. I mean, with credit, you can't start too fast, right? There's a period of time where you need to sort of test a number of things. And even for a team that was very experienced in online consumer credit, the world is constantly changing. Each time you change one thing, you introduce a bias in either the pool of customers you select or how you influence their behavior. So testing and the ability to develop models that learn quickly and adapt constantly is really, really critical. So we were patient enough to go through that period of testing, and we're now ramping up quite a bit. So about $2 billion in loans. Average loan size is $10,000, so that's about 200,000 customers.
So that is pretty fast growth. And do you have plans or hopes to really scale quickly to match, say, a traditional lender?
Yes. So, I mean, the problem we're trying to solve, the fact that credit cards, again, are neither affordable nor responsible in the way they influence customer behavior, that problem has only got bigger, right? 3 years ago, there was $940 billion in credit cards balances outstanding. Now there's 1.04 trillion. So the size of the problem we're trying to solve has increased by 100 billion in the last 3 years. So there's no shortage of opportunity for us, but also a big problem to solve. So we feel we can sort of grow to a large size and originate tens of billions of dollars of personal loans, lines of credit, credit cards that really are, again, geared towards improving our customer situation and helping them choose products that are just better for them.
So you alluded before to lessons learned. Lending Club had its ups and downs. We're not going to delve into the past. Everybody read about Lending Club. And what do you feel you took away? You mentioned growing fast can be a challenge. What else do you feel like you've learned over these past 12 years in this market?
So I think there are a lot of tactical learnings in terms of product strategy and so on. I think probably a bigger learning is that's probably applicable to most of fintech is where do you set the balance between fin and tech? And it's easy, particularly in San Francisco, in Silicon Valley, to do a lot of tech. But so by that I mean focusing on user experience and growing fast and iterating quickly and really moving fast and breaking things. But when you're in financial services, when you're delivering a financial service, the compliance, internal control, and rigor of what banks have been doing for many years of managing risk is also critical. And so finding that balance between the two is absolutely key. And that starts with the team and with hiring people from both sides, great engineers, product, marketing folks, from Silicon Valley who are also comfortable in a fast-changing environment, but making sure you can edge that with more traditional profiles from the banking sector, former regulators, and others who have a better appreciation for compliance and controls. And then the last thing, and probably the most difficult, is to make them appreciate each other and work well with each other. And developing that culture, I think, is a key factor of success for fintech in general.
Interesting. And one thing that I know you guys have built is a blockchain that helps you, I think, with some of that control you were talking about to give you the certainty that the loans are performing the way you want them to, and the transparent information about loan performance and what's in the portfolio, and giving everybody access to that information. Can you tell us a little bit about that?
Yeah. So one of the issues we had at Lending Club was a data integrity issue, and we took a step back and said, okay, how can we make sure that never happens again? And it's very sort of efficient, technology-enabled way to achieve that. And so we designed a sort of protocol that basically consists of sort of creating a cryptographic signature of every transaction and every document every 10 minutes. And so creating a sort of hash that gets then attached to a transaction on the public blockchain, which enables the creation of a sort of time-stamped, immutable record of that transaction and that document at that particular point in time. So it's very powerful. It operates in a way that's entirely automated, that's very low cost. I think it's still experimental in the sense that it's not replacing a more traditional system of record. I think there's going to be some time that needs to pass before sort of, regulators and auditors really accept that blockchain-based system of record as the system of record. So we are running both in parallel, but I think it's a sort of elegant and practical way to use the blockchain protocol.
So eventually you might be able to turn off the earlier version.
That's the hope, yep.
And I could see that becoming a thing in this industry, as a way to develop immutable records. We didn't really talk about your customers, what they look like, who they are, their demographics, their financial status, and also their credit score, the range of credit scores that you will accept.
Yeah. So we're developing really a mainstream sort of consumer credit brand. And by mainstream, I mean sort of full spectrum. So we go all the way down to 600 in terms of credit score. So we avoid deep subprime, and we have some near prime, prime, and then prime plus. And we go all the way to 800, 850 in the top end. And I think what enables us to serve efficiently such a broad spectrum of consumer is really the marketplace model. Because at the end of the day, marketplace lending is about sort of allocating risks to sort of the balance sheet, right? To the investors, to whoever is going to be buying the loan, and sort of having banks and credit unions to take the sort of top end of that risk, so the lower yield, higher credit quality consumers. And then sort of asset managers that are going to be sort of taking the middle or a slice of everything and are looking for a sort of, I think the banks would be looking for a 4% return on assets. The asset managers would be looking for 7%. And then there's a near prime piece where sort of credit hedge funds would be looking for a double-digit return. So the marketplace model really helps sort of allocate that risk. And on the flip side, on the consumer side, it really helps having a more of a full spectrum sort of approach, which makes the platform a lot more efficient. So instead of declining on a lot of applications or mispricing some of the top end, we're able to sort of price risk appropriately because we have the risk appetite and the cost of capital that's matching that risk.
All right, because this is a unicorn track, I'm supposed to ask you about your valuation. You're valued at around $500 million after a Series C. Is that right?
Right, so we're half a unicorn.
Oh, yeah, so far. But is that a goal to become a unicorn? And do you think you might do another funding raise this year?
Yeah, no, so that's not how we measure success. It's nice to have, for sure. But it's, our main goal, again, is to create that mainstream consumer credit brand that's helpful to our customers, that delivers affordable and responsible credit. If we take care of that, the rest will take care of itself. That being said, yeah, we will probably, we're on a path to profitability that's coming along fairly nicely. I think we will be profitable this summer. That being said, we do have plans to raise another round of financing later this year or early next year.
All right, well, this has gone really fast. I think we need to skip to our underrated, overrated round. Okay, underrated, overrated, credit cards.
Way overrated. I think the credit cards in their current form will disappear.
Okay, lending club.
Underrated. No, I mean, it's a wonderful company managed by very competent people. I think it's very misunderstood right now, but I think the market will come to appreciate what they're doing.
Home equity lines of credit.
Underrated. I think that market will come back.
Bank of America.
Overrated.
And Square.
Underrated. I think they've been growing fast, they're doing well, but they have bright days in front of them too.
And they're a San Francisco neighbor. Well, Renaud Laplanche, thanks so much for
Thank
for
you.
joining us today.